Good morning, traders. Today is the 12th of November. Boy, what an exciting week we've had in the markets. I mean, I'm not trying to be an I told you so kind of guy, but we've been calling this, I've been calling this market move quite well over the last 4, 5, 6 months, actually more than 2 years. I started warning after COVID. This is by the way, the U.S. market to the global market index. And when COVID hit, I was very concerned. In fact, I started warning about it back over here at the end of 2019 when we first started having knowledge that COVID was aware of and was spreading. And I was warning everyone to pull away from risk, to prepare for a global market collapse. This could be really bad. We don't know what it is. And then, now granted, was late on the bottom. We didn't actually start buying back into the trend back over to here until June, July. But we caught this nice rally out of it. And I published a research piece that showed that this was going to be a disruption in global markets that was going to prompt a massive rally phase, and then likely prompt massive inflation, massive skewing of economic data, and then eventually revert back into a low phase, which I think we've possibly just gone through here. We could potentially see this move lower as risks continue to escalate going forward. But now that we've kind of, and the U.S. market's different right now because the strength of the U.S. dollar, the economy's stronger. We don't have the excess credit and debt risks. But we've seen this massive downturn, this extreme low that happened both U.S. and global markets. We've seen the rally phase back out of it, and now we've seen the unwinding phase. And I've been quite a bit ahead of this the entire time, other than this buy trigger right over here in June, July. Started warning everybody to get out of the markets back over here in June, July, August of 2021. You can see the markets rolled downward after this time. The U.S. markets continued a bit higher. I was telling everyone back over here to trail your stops, to pull positions, to try to get into a cash position and hedge properly. And then we had this big downturn back over here. I started warning about a wave 4 correction, actually back up here. Started telling you that this would be a wave 4. We were looking at an A, B, C type of wave 4 correction. We were waiting to see if we could get confirmation of a bottom, which would start a wave 5 to the upside. And now it looks like we're starting to see what might become the start of wave 5. I'm still not warning you or telling you to jump into this. This is not the buy opportunity of a lifetime yet, although it could be an early stage basing pattern. You can see how aggressive buyers moved into the foreign markets and the U.S. markets over the past couple of weeks. This has been really an aggressive recovery phase here, but understand that we still have these lower lows. We're still in this downward channel. We have yet to actually break above it. We are seeing some signs here. Let me try to find this chart. This is the new custom cash flow index chart, and this is a weekly chart. And you can see how we've bottomed over here in this lower standard deviation channel. This has been historically a very strong bottoming level. You can see that we've bottomed back over here and really rallied upward last week. This is the SPY. You can see how deep it bottomed here. We had another bottom back over here in 2015-16. We're really seeing a big move higher, and we've cleared this previous high, but we need to kind of get above this high and continue to move forward to the upside. So the next phase here would be to attempt to get up to this green line, which would be our outer standard deviation channel. You can see this has acted as moderate resistance in the past. This means we might have another 4, 5, 6% rally before we run into some resistance. So from this standpoint, when we look at the U.S. markets here or the global markets, what we're really looking at is the potential for resistance possibly up in this area for the global markets, or potentially up in this area over here, 60, 61, 62%, which means we have about another 5 or 6% in the U.S. markets and maybe another 7, 8, 9% in the global markets before we're going to potentially run into some resistance. And that's going to be of concern, meaning we have to move into a new upward trending phase to be able to see this happen. I've mentioned this, and I will mention this with the rotational modeling system. The weekly is still bullish. The daily is still bearish on the SPY. We do not have any real confirmation that this is a strong bottom or a new big upward trend yet. The daily is still bearish, so we have to stay cautious. Understand, this is a great bounce. And trading this with options, or trading this potentially with futures, or trading this with a small percentage of your capital, this has been an excellent bounce, and I called it very, very well. But we do not have any real strong confirmation of an uptrend yet. We're still kind of mixed in a broader downtrend, and we do not have any real clear sign that we're going to be near a bottom. So now let's go back over here and let's just start from the beginning and go through all the charts. This is the Consumer Engagement Index. This is a monthly chart. Consumers are re-engaging slightly here. This is November. You can see we've been down here near these deep, deep lows, and they're pulling back. This is a solid basing formation, so we have very strong support down here at the blue line. We have key resistance up here at the purple line, and another higher key resistance level up here at the red line. As I mentioned to you, we need to see consumers re-engage, and they probably will as we move into Christmas and the new year. But right now, we're seeing a moderate level of kind of sideways consumer action. We're not seeing consumers really jump into the economy and or buying stocks. So next we have the large cap index. Large cap index had broken downward last month. This is a monthly chart. Had broken downward at the end of October, broken deeper as of last week into early November. You can see it's recovered quite strongly here. We're going to see how this plays out. We've got very deep stochastics and RSI. And again, this RSI level is probably about the lowest that it's been since 2006, 7, 8. This was the deep global financial crisis mode here for large cap. So we could be very close to a real bottoming level right over here with the RSI level. But we are starting to see some signs of support. We're just not seeing a real strong upward trend yet. And this is something that I would look for. Obviously, if the markets were to enter a wave 5 rally, we would see this start to build some support and start to really inch itself higher. The custom global asset index is doing the same thing as kind of like the large cap. You've got this breakdown level. This could be a washout low. We're setting up a nice washout pattern. We've got deep, deep RSI and stochastics. You know, we haven't seen a huge selling of assets like we had back over here in 2008. Understand that this move here was a very aggressive selling phase. You know, in percentage scope, maybe it's about the same size here, maybe 0.6, maybe it's 15-20%. Back down here, it's 0.35 to 0.6, 1.35 to 1.6. So that would be, yeah, about maybe 25, 26. This would be about the same, 25, 26. But understand that we're seeing some support, but we're still in a downtrend. So that's the real message here is don't get overly aggressive yet, because we may not be done with trying to wash out a low or trying to find support. The unwinding of the crypto space, we don't know what that's going to do. Global market concerns are still an issue. I mean, at this point, we can theoretically think that, hey, this looks potentially very like a very good setup, and it might be. But from a longer term perspective, our primary goal is to protect capital and not make foolish trades. So that's what we're really trying to do right now, is stay away from risk, even though there's some pretty good trades setting up. Next, well, I should mention this as we get into gold. Gold and silver have really started to move. And the reason gold and silver are starting to move, in my opinion, is that traders realize the crypto market and the Bitcoin market and the global asset bubble as millions and millions of people, crypto enthusiasts and Bitcoin enthusiasts, suddenly realize that, wow, it may be all a great big Ponzi scheme. It may be one big fraud. And they're, you know, literally looking to move money, whatever they have, into something that's safe, which is why we're seeing foreign markets become attractive. U.S. markets stay attractive. Why? Because it's backed by the U.S. dollar. And gold and silver are becoming very attractive. And why? It's because it is a physical asset that you can hold. It's not paper money. It's not vaporware. It's not somebody, somebody telling you that this is great and everybody loves it. This has historically been the true store of wealth during multiple collapses. I can count at least 6 or 7 collapses in China alone, major economic and regime collapses where the paper money just got destroyed. Everything went back to copper, tin, gold, and silver. Same thing with the Roman Empire. Every empire in the world has relied upon trade and raw materials. So we're talking about food, chicken, eggs, agriculture, gold, silver, services. It comes down to, you can't move 1,000 chickens easy. You can't move 100 cows easy. You can move 100 ounces of gold fairly easily. It's small, it's portable, you can haul it around, it's a good store of value. So gold and silver are starting to become very attractive. And as I'd been warning you, these bottoms over the last couple of years has been an incredible value if you were to try to take advantage of these extreme lows. And you still have the opportunity to do it. Gold in here at 1,700 and silver at around 21, 22. These are still incredible opportunities. I mean, silver could be 60, 80, $100 an ounce. Gold could be, $5,500, $7,500 an ounce, and you're capable of buying those right now at about 1/20th or 120. About a 75% decrease or more. So you still have opportunity to do so. Now, I personally started buying into gold and silver back here in 2012, 13, 14, when gold was, I believe it was like 12.80 an ounce, something of that nature. I started buying into it. Should have leveraged really heavily into it back then, but we have another massive rally taking place back over here. So we're really what we looked at on the way down. It was the 2000, actually 13, 14 is when I started getting into gold. Okay, so now next we have the tech rally or the tech ratio index. Technology is at extreme lows. It may, so my feeling on technology is this, okay? We're not done with inflation. I don't think inflation is going to unwind until sometime maybe next year, maybe in 2024. And this is a big issue because the Fed is going to have to continue to manage interest rates in a way to try to properly unwind inflation and not create another bubble. Real estate's already moving in a very aggressive downward stage. It's not showing up in the numbers. Trust me, it's there. Underlying everything that's going on, the market is collapsing. Demand in real estate has gone from, by my modeling system, 140 plus about 8-12 months ago to minus 37. So when you figure out from a standpoint of that minus 37, just round that to minus 35, how many 35s does it take to make up 140? By my estimation, you're going to have about 4. So you've got essentially a decrease in market demand by close to, and I'm doing the math real quick in my head, by about 82%. So the market has changed dramatically in real estate, and this is going to show up over the next 5, 6, 10 months, especially if the Fed continues to manage interest rates a little bit higher going forward. So as far as technology goes, technology will become a decent buy trigger eventually. Maybe near the end of this month, maybe in early December, maybe in early January. We're just waiting for it right now. I would advise you, though, if these things, if gold, not gold, but if Microsoft, Google, Facebook, or Meta and others, start to get down into that area where you could begin to accumulate small numbers. Think of them as, if you wanted to put, $1,000 or $2,000 a month into some of these stocks, Microsoft, Disney, and Disney's really a technology company now. Understand that they have their theme parks, but they have their streaming channel, they have their technology, their digital technology. They're really more of a technology company, a broadcast company. But again, if you wanted to start accumulating on a small basis and dipping your toes in, taking, let's call them little scoops at it over the next couple of months. I think long term, you're going to see this revert back up here into this 40, 50, 55 range over the next possibly 2 or 3 years. So this could be a good time to start scooping things up. Just keep it small. Don't get overly aggressive yet, because we could have another kind of a washout pattern here. Okay, we've gone through this, the US to global market index, big moves, very big moves last week. This is very strong confirmation, especially here in the global markets. You're seeing, quite a bit of money moving into global markets and trying to reassure this COVID low, which is good. We need to see this hold up. The US Devaluation Trend Index, this is one of my custom indexes. It's a monthly chart. It is forming a base, a bottom. It is holding above this purple support line. We've been highlighting this 1.5 red line Fibonacci level here. We need this to hold if this bottom is going to hold, and if we're going to start some sort of a new reversion. Now, remember, we have this upward channel. I'd almost like to be able to draw a line here, but we have this upward channel here, and a reversion between this upward channel would put us somewhere up here in the 1.1, 1.15 area, where I'm trying to point right up here. So this would be a moderately big reversion, possibly a 40 to 50% rally from current lows, possibly a little bit higher. So if we were to see a wave 5 or any type of moderate reversion happen, we would see likely moves back into the 2021 highs back over here, which would put us, possibly 5 to 10% below all-time highs in the US market. So we need to see how this holds up, but it is forming a good base. We're just in a continued downtrend here, guys. We don't have any real solid basing. It looks like a good solid base. Technically, it is a good solid base. I say in my gut, I think we're moving into a reversion cycle here, an upward cycle lasting maybe 6, 7, 8 months. But the long term is we don't have any confirmation of it. So this is just my gut telling me that the markets are going to revert, resettle, try to find a base, see what happens, but we have no real technical confirmation. So I can't urge you to do anything other than follow my gut, trade accordingly, keep your risks very moderate. Cash flow index, we've already gone through this. Very solid infusion of cash coming in here. This is a big move, folks. This is a very big move. This is the SPY down here. This is the RSI. This is stochastics. As I mentioned to you, we would likely get back up to this green level here, stall around a little bit, and then attempt to move a bit higher. These were the highs back in June 2021. So when I call a reversion trade, I'm talking about getting up into possibly like this area here, above this green line in the 1.5 to 1.7 area. And that would mean that we probably got another 15 or 20% move here. Now, this cash flow system measures the amount of, it's designed to measure the amount of momentum. So think of it like this. You're stepping on the gas right now, but you haven't reached the maximum speed. It's got to build the momentum to go up there. So right now, this is basically, we're stomping on the gas. Buyers are stomping on it, trying to get the markets to move higher. That's what they're trying to do in this manner. But we haven't yet seen that fuel translate into speed yet in price. It's starting to build some momentum. It's moving higher. Eventually, if we continue to see this continue to move higher, we're going to see that momentum translate into price. But right now, we're stomping on the gas. What we need to do is see it continue up in this area, 1.4, 1.5, 1.6. That's going to mean that there's continued acceleration in price. And again, that momentum takes a while to translate into actual price movement. Okay, volume ratio is holding up. There is some accumulation in the markets. We're seeing a fairly strong little accumulation with volume here. We're not seeing that big breakdown. You can see here the stochastics is moving higher. The RSI is kind of flatlined. This is a very good bottoming signal potentially setting up. But again, we need to be cautious and wait for some real confirmation. The commodity to gold index here is moving a little bit higher. This is telling us that again, this is the move in gold. Let me explain this to you. The upward move in gold would likely prompt some sort of a sideways type downward move in this price index. So what we have here is we also have the capability or the potential that oil is moving a bit sideways and strengthening as the economy potentially tries to recover a bit. So this could move up into the 1.6, 1.7, 1.8 range as we kind of reflate a bit on the potential of a Fed pivot or a stronger foreign market economy, some asset buying. Eventually, in my opinion, it will flatten out, and the move in gold will show that there's some real fear in the economy. Now, understand that gold and silver can move up while the U.S. stock market and global stock market move up as well. So there is nothing saying that you could not have precious metals moving higher on extreme or increased risk factors while the U.S. stock market and the global markets reflate a bit and recover a bit higher. That is fully capable of happening, okay? We just need to see how this reflates. Ideally, ladies and gentlemen, this 1.8, 1.9, 2.0 level is an upper boundary. Historically, that's a pretty good upper boundary. I apologize, I have a tickle in my throat. The FANGs index, again, I mentioned to you how this had historically been extremely strong, bottoming last week. And again, I'm not trying to be, and I told you so, but I do want you to understand how to read these and how to start following along and paying attention more aggressively. I pointed out how this historical level has been very deep bottoming. Soon as we get down below this green line here, we're into early stage bottoming. And look at what happened to the FANGs index last week. I'd been telling you back over here that we were looking at extreme bottoming. We could see a reversion back up here into the 165 to 180 range. I called it out last week that this was an extreme low or potential extreme low. We needed to stay cautious. But again, look at this bottom set up here. Now we need to see some follow through. We're back up here to the middle channel here. So as soon as we get above this red line, we're into bullish standard deviation. And we could continue a new move higher. But again, it's just incredible how these charts work. I mean, I love them. I don't know what you guys think, but I mean, consider it this way. A lot of other people are out there guessing and trying to figure things out and understanding. And what I'm trying to do is I'm trying to use these custom indexes and my interpretation of them to historically view the markets in a different way. I'm trying to identify, look, this has historically been a very strong bottoming formation. And look, we hit it again here. I'm not trying to, tell you what you should be doing. I'm trying to get you to realize that the markets operate using these custom indexes I have in, traditional manners that can be replicated and can provide some real valuable information. You can front run some of these signals with 10 or 15 or 20% of your speculative capital while keeping the rest of your money extremely safe in cash or metals or what have you. But the long and short of it is we've got some great indicators here and they're picking the markets apart like mad. Remember, the actual top that occurred up here in the FANGs index occurred, in October, November, well before the markets actually turned around. And we had been warning because of this rotation here. We had been warning back here in July, August, September, October, or I had, to protect your trades. Don't trust this trend. The global markets had reverted. My indicators had shown that this was just an carry on, let's call it, rally. And I kept telling you to be cautious. This is what's going to happen next. All through this phase, I kept telling you that this was the end of a wave 4 move, looking for a wave 5 setup. Now we're in the early wave 5 setup, and we're looking at the next big phase, which could be extremely higher. All the while, I've been warning you that gold and silver were skyrocketing, and FANGs were setting up an extreme low. Now, what happens here is that in FANGs, think about it. All of this technology, all of this speculation, the Gen Z, the Gen X, I mean, everybody from basically let's call it 70 onward is technically savvy, and there a lot of them are involved in crypto and Bitcoin and what have you. And there's literally billions of dollars in capital that's been moved into digital currency. And digital currency is going to stay here for a while. I mean, it's going to settle. It might take 10 or 20 years, but it's going to settle and it's going to probably stay regulated. And there's going to be some issues globally with trying to regulate it. But this capital is speculative capital. It is used for trading, betting, speculation. What is going to happen with the unwinding of the FTX crypto exchange and the risk to the crypto market as this continues to unwind is that these investors, these potential hundreds of billions of dollars, potentially setting up in various assets, are going to be looking for safety. Safety is going to come in the form of the strongest currency base, the most likely opportunity for growth and returns. And remember, U.S. technology sector, even though it is contracting revenue and what have you, is still producing extremely solid profits. I mean, we're talking billions of dollars every quarter. I mentioned to you a couple of weeks ago with the Google and the technology earnings. Yeah, oh well. So Google, instead of making 7 billion, they made 6.93, and everybody freaked out about it. The reality is that's a 4% or 3.5% drop on their revenues. They're still making $6.9 billion a quarter, and will likely probably continue to make $6.9 billion a quarter. So, in the long and short of it, yeah, I want to be involved in Google, especially in technology, especially U.S. technology backed by the U.S. dollar, where we have strength, we have revenue, we have earnings, and we have a basis for continued revenue and income. That could drive this way up here into the 180, 200, 210 range, maybe even higher, and particularly over the next 5, 10 years. We'll see. And again, we're in a renewed technology phase. This whole 2017, 18, 19, 20, 21, this whole thing has been a technology boom, a resurgence of technology. This has been an unwinding of an excess bubble. We could come right back up to these levels, base for a couple of years, and then move another leg or two higher, meaning we could be in the 3, 4, 500 point range here in 5, 6 years from now, depending on what happens with technology. Okay, the metals index, huge, huge rally. That triple bottom was just too stupendous. This was an excess phase low, just like I called it. It's been a tremendous week. It really has. Everything that I've been warning about is really coming to fruition right now with the unwinding of the cryptos and the change in how capital is reacting. Now we need to see it follow through. But this is a big move for metals, and this will likely shift metals into a solid upward trend over the next 5 to 7 years. So here we go, guys. Position yourself accordingly if you have cash sitting in the markets. Remember, holding physical coin or bars is much better than paper. And again, I don't trust anybody that's saying they're going to hold it for me in a secured vault. Remember, that's what these crypto exchanges were doing. We'll hold your money. Don't worry. Put it over here. We're secure. Trust me. And now look what happened. My opinion is put it in a box, stick it under your bed. It's not like it's going to go bad. If it's real metals, you have it, you hold it, you can access it anytime you want. You don't have to rely on someone to promise to send it to you. And get ready. This could be the next big phase in metals. We've very rarely seen any type of a move like this. I mean, only time we've seen anything similar to it's right here, the crypto recovery or the COVID recovery. Otherwise, we've never really seen anything like this. This is a huge move. It's a $20 move. So here we had a almost $20 move right here. Here we had a $20 move here. Here we had a $20 move here. This was after COVID. We had a $20 move here. We had a $20 move right here, but this is very solid after a base, and we've broken through all of this resistance and channeling. Now the next phase is to get back up into this gold level, what I call the yellow brick road, these gold lines, yellow lines, and then continue to melt up higher. Okay, the smart cash index, the global index, like I said, it's broken. It's back up above resistance. It's moving higher. This is a very big shift. Capital is piling into undervalued assets throughout the globe, trying to catch a move. A reversion level here could put us in the 160, 165 level. That's about a 20 to 22% move to the upside. We could see this happen fairly quickly. Once we get to this level, I think we're going to stall in early 2023 in the global markets and try to revalue what the actual economy is doing for 2023 and the risk factors ahead for the markets. And we have the US stock market index, big rally here, big solid rally off of these support channels. And you can see here, we've still got to get above this resistance level and this purple resistance level, but we're making good headway. So understand this downward purple resistance level is still very concerning. We could, as this bases and bottoms, we could flag out over here for the next couple of weeks, maybe headed into December, like December 10th, 15th in that area, and then attempt a breakout. Once we get above this breakout, then we're going to end up in this 12, call it 1210, 1220 area fairly quickly. And I expect that to happen before the end of the year. The valuations index is starting to form a nice solid base and bottom. This is great. Again, we're going to likely see a recovery, a reversion trade up into this, let's call it 60, I'm going to call it 64, 65, maybe 70 area. We could get up as high as this blue line here, but I really think like the 65, 70 area is about where it's going to be. And the reason I believe this is going to happen is I believe winter's going to hit. People are going to take care of their Christmas. They're going to take care of their holidays. They're going to take care of their family. We need to see what happens with oil. We need to see what happens globally with the war. We need to see what happens with cryptos and Bitcoin. And so people think of it as a good Christmas, a good holiday, a good end of the year, but somewhat concerning in the sense that we've lost that euphoric, nothing could go wrong phase. Okay, now we know things could go wrong. Now we know that inflation is still a concern. Now we know that cryptos are a problem potentially. Now we know that inflation is still here and the Fed's going to potentially have to keep battling it. So we're going to do what we can. We're going to make it a good Christmas, and the markets will likely recover because of that or revert higher because of that. But as soon as that's settled, as soon as we're down 20th, 24th of December, and then we're starting to look at what's coming next year, boy, next year's got a big question mark on it as far as what we're going to be dealing, what the Fed's got to do, what the government's got to do. Okay, so this could be a nice little reversion, melt up for about 65, 75, 90 days maybe. Then we need to kind of see what happens and what's leading us into 2023. Okay, and the volatility index. This is again one of my favorites, and I want to point out that even though we're seeing very strong rally phases, we are not out of the woods yet. We have seen this move off of this extreme low, rally quite a bit higher, hook higher on stochastics, move higher on RSI. But ladies and gentlemen, we still have a huge resistance band right up here. We have not gotten into this above this purple or pink line here. We are not in extreme upward trending. If we were to move into extreme upward trending, we could see a spike kind of like this coming up into extreme bullish mode, stall out and come back down here into bearish mode as it's trying to find some resistance before making a bigger move. And here's good examples. You can see here as we reach this upper area, we got up here in the 1314, rolled down here into 78, back up here into 1314, rolled down here into 78, back up here into 1314, a little bit higher than 14, then rolled back down here into 910, and then here's COVID breakdown. So as we're trying to move and shift away from this downward sloping channel right now, we could see some extreme volatility trying to base. So we have to be very, very cautious because like I said, this could be literally a 12 to 15% or more rotation, and the law of averages comes into play. A lot of you are aware of, or maybe not, the law of averages. So understand, as we base, and let me go back over here and show you a chart, a better chart. And This one will work. No, let's go over here. So as we start moving, so imagine we draw a line across here, right? Let me do this. Copy. Get into an image editor so I can show you what's going on. Don't remind me again. Control new. Paste. So here's the image. And what I'm going to try to do is draw a line. And I'm going to try to pick this low here. Once I find my cursor, there it is. Across here. And okay, we will change the color to yellow, make it thick. Perfect. And then we will copy, paste. Oop. Okay, let me try this again. And what I'm trying to do, ladies and gentlemen, is show you what's coming. So here's the upper channel, right? And now what we're going to do is we are going to pick the middle reversion area, approximately right there. And we'll change this a little bit to cyan. And what we have here, ladies and gentlemen, is a scenario where the law of averages comes into play. So what I'm trying to tell you with the law of averages is that, yeah, okay, this will do it. And let me try to pick a lighter color. What we have with the law of averages is if the price moves up and sideways over extended periods of time, this reverts into kind of a channel. This reverts into a sideways kind of a price channel, whereas understand that price would be operating from a standpoint of over 20, 30 bars. You've got this kind of a flattening channel. And what that means is that the law of averages are going to flatten out. If you take and measure upward momentum versus downward momentum, it's going to be near zero. If you take shorter term or longer term moving averages, they're going to start to flatten out. They're not going to be sloping higher or sloping lower very aggressively. You start measuring RSI or momentum or many other technical indicators, they are going to flatten out. And that's called the law of averages or the law of means. What that also does to trading systems is it moves them into extremely volatile periods where you could be going long or short at the most inappropriate time with very high degrees of risk. So understand that as we move into this mode, if we fail to, let me find my mouse again, if we fail to move into kind of a breakout trend and we enter into this sideways trending, then what we are going to do, ladies and gentlemen, is we're going to move into a very serious, very risky period of time for trading systems. And I can't explain it to you enough. You know what happens if you had over allocated your trading with hypothetically a 10 or 15 degree risk factor for your stock trades, and you take a series, call it 4 or 5 or 6 moderate losses, how would you feel about losing 40, 50, 60, 70% of your assets throughout this sideways trading period, this sideways bottoming price activity? You'd probably be very, very angry at the fact that you were not prepared for the fact that flat sideways activity could become extremely dangerous for you. And again, we don't see that often. We really haven't seen it since last time I would say that we would have seen it would be in probably the late 70s, maybe mid 90s. But this is another example of flat sideways kind of trading right here, 2017. And we could end up seeing the same type of thing. We could end up just kind of flatlining, basing through most of 2023 without having any real opportunities. So be aware that the real opportunity here comes from seeing some trending. And we may see that through November, December, January, maybe into February, March. But after that, I'm going to tell you that it becomes very concerning as to what we're going to see as far as trending. We may enter another period of devaluation. We may enter another period of inflation, especially if China opens up and starts to roll their economy. We could see another inflationary wave, especially if this buying overseas and foreign markets sparks some sort of a new wave five speculative phase. But understand that it's going to get very interesting. You just have to be aware of the risks that come with general market malaise. All right, I think that's it for now. Let me come back over here, make sure we've covered everything. So we left off here with the volatility index, one of my favorites. Remember, this could move higher. A move above 10 or 11 is going to move us back into bullish trending. I really think we're going to melt up probably to about 12, maybe 13 and a quarter by the end of the year. And then we will roll back down in early 2023 to 9, 8.5, 9, move into this more malaise, set up a base in early 2023, and then attempt another move back up to 12 or 13 or 14 again. And that's the end of the custom indexes. Okay, so I've gone over quite a bit. I'm going to urge you, ladies and gentlemen, to keep following what I'm doing. The most important thing that I can tell you is that I am using these indicators to try to gauge what's happening 90 plus days in advance. And I'm trying to keep you aware of what the setups are and how these work. To me, these are a bunch of gauges in the cockpit of my race car or superjet. Long and short of it, I read these things, I see what's happening, I can play along, I can look for early warning signs, and I can tell you where we might see some real opportunity and what to expect. But secondarily, I can also tell you where risk factors are and how you need to protect yourself. And that's really the true value of what we're doing here. Again, I warned of the topping back in July, August, September of 2021, told everyone to protect their trades, try to pull out at profits, try to get into a cash position. I kept everyone away from the collapse in early 2022. I started telling people to hedge into metals and to look for the bottom, which is now set up. I started warning about these bottoms and how everything was going to set up across these bottoms here. Now we're moving into what I would call the initial impulse wave of a potential wave 5 rally, but we do not have any confirmation yet, so we still need to be very cautious. The real value here is you make your own decisions. I'm just guiding you on a longer term basis. When we enter into that new bullish phase and we get some real confirmation, we will move into that aggressively with the MRM system, the MENT rotational modeling system, and moderately conservatively with our actual trading. We will let the MRM do what it's supposed to do with our retirement assets. And as far as trading goes, we will stay very cautiously hedged. The real reality here, ladies and gentlemen, is we could see a big move in the markets globally and in the US. But as long as these metals keep performing to the upside, understand that this is just like what happened after 2004 and 2005. What is happening is traders are realizing that the excesses in the system are creating a very fragile environment, which could lead to some sort of a collapse event. Which again, as I mentioned to you and continue to tell you, longer term cycle trends say that's going to happen 2007 or 27, 28, 29, and 31. Somewhere in that time frame, we're going to be looking at a massive crisis event. Until then, we're in a melt up phase, very similar to 2005, 6, 7, meaning that's where we're kind of at right now, to 2008, 9, 10, 11, meaning that 2027 through 30 would be similar to 2005, 6, 7, 8, 9. Well, sorry, let me rephrase that. Would be similar to 2007, 8, 9, 10, 11. Okay. We got another, in my opinion, 4.5 years, possibly 4.5 years of a moderate melt up. There's going to be some concerning issues, but it's going to be a moderate melt up, in my opinion. Okay, guys, let's get ready here. It's going to be a very interesting time. And remember, follow the let me try to show you here. Follow the live trades data. I don't know if you're following any of this, but boy, oh boy, we've caught some really. I was just looking at them this morning. We come in here, we go into the hot list, the value stocks. Oh, lost my internet. All right, I'll check this later. But again, get into live trades. Check out the hot lists and the pure alpha trades, man. They're really kicking some rear end. Okay, guys, that's it for now. Talk to you later.